For most of my life, I believe that sometimes war was necessary. Yeah, it was ugly, people died, it devastated lives, but somehow the economy would make it through. Markets might get volatile, stocks might dip, but money would be fine, right? And then I grew up and I started actually looking at history, not headlines, not narratives, real history. And once you do that, something becomes very clear. Every major war does the same thing to money every single time. Doesn't matter who wins, doesn't matter who started the war, doesn't matter what politicians promised. War rewires the economy. And when that happens, paper wealth breaks. Quietly at first, then all at once. Bonds that were safe stop being safe. Savings that felt responsible start shrinking in real terms. And people are left confused, asking the same question over and over. How did I do everything right and still fall behind? This video isn't about cheering for war, and it's not about fear. It's about recognizing a pattern, one that shows up every time conflict escalates. And if you're watching this as tensions are escalating right now, including the recent US and Israeli strikes in Iran, this is not political commentary. It's just real-world context for this pattern that keeps showing up. Because when you zoom out over the last 100 years, World War I, World War II, Vietnam, the War on Terror, even today, the same assets keep winning and the same ones keep failing. So today I want to walk through the economics of war as a regular guy just trying to understand how money behaves when the system is under the stresses of war. Let's dive in. By the way, my name is Noel Lorenzana. Please be sure to like and subscribe if you like this type of content. Why war always breaks paper wealth. War destroys money because of how war is paid for. There are really only three ways governments fund a war. They can raise taxes, they can borrow, or they can print money. That's about it. Now, raising taxes during a war, that's politically toxic, and it almost never covers the full cost. So they borrow, they issue bonds, lots of them. And when borrowing isn't enough, which it usually isn't, they print money, expanding the money supply in their usual ways. It's a different era, but it's the same outcome. And this is where paper wealth starts to crack, because war does two things at the same time. First, it floods the system with new money. Second, it reduces the supply of real things. Factories get repurposed, trade routes get disrupted, energy gets scarce, and even the food supply. You basically end up with more dollars chasing fewer goods. That's inflation. Not the 2% target kind you hear about, the real kind. And inflation is brutal to paper wealth. Cash just sits there losing purchasing power. Bonds lock you into fixed payments that don't adjust fast enough. Pensions, annuities, long-term promises, all built on assumptions that no longer hold. On paper, everything looks fine, but in real life, you're maybe earning 4% interest while the cost of living is rising by 8%. So you're basically losing wealth in real terms, quietly falling behind, and you don't know why. And here's the uncomfortable part. This isn't a policy failure, it's not mismanagement, it's not corruption, at least not outright. It's about the math that ain't mathin', as they say. Paper wealth depends on stability. War destroys that stability. And once inflation takes hold, it doesn't politely stop when the war ends. It lingers on, it leaks into everything, which is why people always feel like the economic damage shows up after the fighting ends. History's pattern, the same winners every time. This is where it stopped being theory for me, because once you understand the mechanics, you start noticing the same pattern over and over again. Let's keep this simple. World War I. When World War I broke out, markets didn't adjust. They shut down, literally. The New York Stock Exchange closed for months to stop panic and gold runs. Bonds struggled, stocks went nowhere. But commodities, steel, oil, wheat, they exploded higher because war runs on materials. Gold didn't make anyone rich, but it did what it was supposed to do. It held its value. World War II. This one's important. To fund the war, the government borrowed enormous sums of money, and to keep borrowing cheap, they capped interest rates. The result? Inflation ran higher than bond yields. So bondholders, the safe investors, they lost purchasing power year after year. They helped finance the war whether they realized it or not. Commodities did well again, factories, fuel, metals, all in constant demand. Stocks got a little messy. If you owned them early, it was painful, but if you held through the war and into the recovery, you were eventually rewarded. So timing mattered a lot. Vietnam in the 70s. This is where things got ugly. The US government tried to fund an unpopular war overseas along with massive social programs at home. They didn't want to raise taxes too high, so they borrowed and they printed. Then inflation crept in, and then it got really bad. Bonds were crushed, stocks struggled for years. Gold and commodities, they took off. Not because people were greedy, but because trust in paper money was breaking down. Fast forward to modern times. After 9/11, you get the war on terror, long conflicts, massive spending, and very loose monetary policy. Stocks basically went nowhere for years. Bonds looked like they worked, but only because interest rates kept coming down. And gold, it did very well. Then you get Russia and Ukraine. Different war, same pressure on the system, energy, food, supply chains. Only this time, rates were going up, not down. Bonds collapsed, commodities surged, gold again held its ground. Same forces at work, different setup. And here's the point. You just need to notice the pattern. When war enters the picture, paper promises struggle, and real, necessary things rise in value. Why hard assets keep winning? This is where things clicked for me. War isn't an economic theory. It's a physical event. Stuff has to move. Stuff gets destroyed. Stuff gets harder to get. Energy, food, materials. And once you look at it that way, the outcome almost explains itself. During war, governments need enormous resources fast. They don't have the political appetite to tax enough, so they borrow. And when borrowing isn't enough, they expand the money supply. That part is consistent across every war. But here's the part that matters. At the same time money is expanding, the supply of real goods is shrinking. So you end up with more money in the system and fewer real things to actually buy. If you need fuel, you bid up energy, or more specifically, oil. If you need steel, copper, or food, you bid up those raw materials. Those prices don't rise because investors are optimistic. They rise because someone needs them. Now, gold is a little different. Gold doesn't fuel tanks, it doesn't feed anyone, but it also doesn't depend on anyone's promise. It just sits there, unchanged, while everything around it is adjusted. So when paper claims start losing purchasing power, and they almost always do during war, gold doesn't have to outperform. It just has to not get diluted. And historically, that's been enough. This is why hard assets don't feel obvious before conflict, but feel painfully obvious after. Stocks, real businesses, real risk. This is usually where people push back. They'll say, okay, but stocks are paper assets representing real businesses. They can raise prices, they're inflation hedges. And yes, sometimes that's true, but war doesn't create clean inflation. It creates messy inflation. Costs rise faster than expected. Demand gets uneven. Rules change, and suddenly labor is tight and energy is expensive. So yes, companies are real, but the environment they operate in becomes unstable. And that matters because during war, some businesses do very well, others can get crushed. Energy companies tend to do well, Defense contractors usually benefit, and resource producers often come out ahead too. But a lot of the market doesn't live in that world. Consumer businesses tend to struggle when people are stressed, margins get squeezed as input costs rise, and planning gets harder when nothing feels predictable. That's why stocks tend to be volatile during war, and timing is everything. If you bought stocks early in World War II, it was uncomfortable for a long time. If you held through the war and into the recovery, you were eventually rewarded. In other periods like the 1970s, stocks didn't really protect purchasing power at all. You could have owned great companies and still lose ground for years. So when people say stocks always win in the long run, my response is usually, which long run? And can you actually live through it? Stocks are exposure, they're risk assets, sometimes benefiting, sometimes not. The myth of the safe portfolio. This is where things get uncomfortable because for decades, people were taught a very simple idea. You own stocks for growth, you own bonds for safety. When stocks fall, bonds protect you and vice versa. But that only works in a stable world. It works when inflation is low, when interest rates can be cut, when confidence in the system is intact. War breaks all those rules. During war, governments spend aggressively, debt rises quickly, and inflation becomes the real problem. Now, in the very short term, major geopolitical shocks can actually push gold down temporarily. When markets panic, investors sell whatever they can to meet margin calls, even gold and silver investments. But historically, once the dust settles, war tends to lead to aggressive spending, rising debt, and inflation, and that's usually when hard assets start to move. That's also when bonds stop behaving the way people expect, because bonds don't protect you from inflation, they expose you to it. You're lending money at a fixed rate in a world where the value of money is falling. That's not safety, that's a slow decline of your money. Historically, this is why wartime periods have been brutal for conservative portfolios, not because people were not responsible, but because the definition of safety quietly changed. What this is really about. I want to be very clear here. This isn't about rooting for conflict, and it's not about telling anybody what to buy. It's about understanding history and patterns. War forces governments to spend beyond their means. That spending has consequences. Those consequences show up in prices. In over 100 years, the same type of assets keep responding the same way. Things that can be printed tend to lose purchasing power. Things that are scarce, necessary, or independent tend to hold up better. And if you're watching this as events are unfolding right now in the Middle East, that's exactly why I wanted to make this video. Not to predict what happens next, but to show how money has always behaved when conflict escalates. This is something I think about a lot, not because I'm pessimistic, but because I want to understand the system we're actually living in. So if there's one thing I hope you take away from this, it's this. Most financial advice is built for periods of relative calm. History has been pretty consistent about how money behaves during times of war. Paper promises struggle. Real things, hard assets, tend to hold up better. That's just how the system has worked for a very long time. But let me know what you think about all this in the comments below. And if you want to know about which hard assets might do best during times of war, then you need to check out my video right up here. And as always, thanks for watching, and I'll see you in the next video.